Most people think Elon Musk became rich overnight. They imagine a genius who woke up one day, launched rockets, built electric cars, and suddenly became the world's richest man. But that story is comfortable, and completely wrong. The real story begins in the late 1990s, when Elon Musk was not famous, not powerful, and definitely not rich. In 1995, Musk arrived in the United States with student debt, a second-hand computer, and one dangerous belief. Money is a tool, not a goal. While others chased high salaries and safe jobs, Musk studied something far more important: how capital moves. His first startup, Zip2, wasn't glamorous. It struggled. Investors doubted him. Employees complained about long hours. At one point, Musk slept on the office floor because he couldn't afford rent. But behind the scenes, he was learning a lesson most people never understand. Ownership beats income, always. When Zip2 was sold for around $300 million, Musk didn't celebrate like a lottery winner. Instead, he asked one question that would shape the rest of his life. Where can I put this money so it multiplies, not protects? Most people, after their first big win, play defense. They buy comfort. They buy safety. They buy status. Elon Musk did the opposite. He reinvested almost everything. He poured his money into X.com, which later became PayPal, again taking massive risk while others cashed out early. When PayPal sold, Musk walked away with about $180 million. And here's the moment that separates him from everyone else. Instead of diversifying into dozens of safe investments like advisors recommended, he made a move that looked financially insane. He put nearly all his wealth into 3 companies: Tesla, SpaceX, SolarCity. By 2008, all 3 were close to failure. Musk was almost broke. But this wasn't luck. This wasn't gambling. This was the first clear sign of Elon Musk's real finance secret: a mindset that rejects short-term security in favor of long-term asymmetric bets. Most people believe the biggest danger in money is risk. Elon Musk believes the real danger is playing small. After PayPal, financial advisors surrounded Musk with warnings: diversify. Protect your capital. Don't put all your eggs in one basket. To them, Musk's next move looked irresponsible. But Musk was following a rule almost no one understands. Take massive risks only when the upside is unlimited and the downside is survivable. This is where average investors get it wrong. They take small risks for small rewards: day trading, hype stocks, quick flips. Musk does the opposite: huge vision, long time horizon, concentrated conviction. When he invested in Tesla and SpaceX, he wasn't betting on profits next year. He was betting on industries that would exist for the next 50 years. Electric vehicles replacing gasoline, private companies conquering space, renewable energy becoming inevitable. In 2008, the world laughed. Tesla was burning cash. SpaceX rockets were exploding. The global financial crisis hit. Musk had to choose between paying rent or funding SpaceX. He chose SpaceX. That moment reveals another hidden finance truth. Musk allocates money to mission-critical opportunities, not comfort. He didn't ask, "How do I stay rich?" He asked, "How do I build something that must win eventually?" This is why his investments look reckless in the short term but logical in the long term. Musk understands something Wall Street often ignores. If you're right about the future, concentration beats diversification. Diversification protects wealth. Concentration creates it. But here's the catch most people miss. Musk only concentrates after obsessive research. He studies technology, cost curves, physics, and timelines until the risk becomes calculated, not emotional. To outsiders, it looks like gambling. In reality, it's deep conviction built on data. And this rule changes everything. Because once you see risk this way, money stops being something you fear losing and becomes something you deploy strategically. If you ask most people why they fail with money, they'll blame bad luck, low income, the economy. Elon Musk blames impatience. While others chase fast returns, Musk plays a completely different game: time arbitrage. Here's the uncomfortable truth: the longer you're willing to wait, the fewer people you're competing against. Musk doesn't invest thinking in quarters or even years. He thinks in decades. When Tesla was losing money year after year, critics called it a failure. What they missed was this: Tesla wasn't built to make profits early, it was built to dominate a future market. Musk understands something simple but powerful. Compounding doesn't just apply to money. It applies to technology, learning, and brand dominance. Every year Tesla survived, its battery costs dropped. Every failed SpaceX launch produced data competitors couldn't buy. Every delay scared away short-term thinkers. And Musk welcomed it. Because patience acts like a filter, it removes everyone who can't wait. While traders panic during downturns, Musk doubles down on infrastructure. Factories, supply chains, engineering talent. He invests when fear is highest because that's when time becomes cheapest. This leads to another hidden finance principle Musk lives by. Short-term pain is the price of long-term monopoly-like advantage. Most people sell when things look ugly. Musk builds. Most people want certainty. Musk wants inevitability. And here's the detail few notice. Musk doesn't try to time the market. He tries to outlast it. That's why market crashes didn't destroy him, they removed competition. By the time Wall Street finally believed in Tesla, the hard work was already done. The wealth explosion everyone noticed was just delayed recognition. So when people say, Elon Musk got lucky, what they really mean is, he waited longer than they were willing to. For most investors, failure is the end. For Elon Musk, failure is data. This single belief changed everything. Between 2006 and 2008, SpaceX failed 3 rocket launches in a row. Each failure cost tens of millions of dollars. Investors panicked. The media mocked him. Engineers feared the company would collapse. Musk didn't panic, because he never priced failure as a total loss. Here's his hidden finance rule. If failure teaches you faster than success, it becomes an asset, not a liability. Traditional investors avoid industries where failure is expensive. Musk runs toward them, because the learning curve scares competitors away. Each failed SpaceX launch produced engineering insights competitors didn't have. Proprietary data no money could buy. A team hardened under pressure. By the 4th launch, SpaceX succeeded. That single success unlocked a NASA contract worth over $1.6 billion. What looked like failure became financial leverage. And Musk applies this logic everywhere. Tesla's early production hell. It forced automation breakthroughs competitors later copied. SolarCity's struggles. They accelerated vertical integration across Musk's companies. This leads to another overlooked money principle. Losses are dangerous only if you quit. If you survive, they become barriers for others. Most people cut losses early to be smart. Musk holds through intelligent pain. Not blindly, but strategically. He structures companies so early losses increase future efficiency, strengthen brand credibility, reduce long-term unit costs. In simple terms, Musk pays early so others pay forever. This is why copying him is hard. You can't copy the reward without enduring the discomfort. And this explains why, when success finally arrives, it looks sudden, even though it was years in the making. Most people are taught one simple rule. If a business isn't profitable, it's failing. Elon Musk doesn't agree. He cares far more about cash flow timing than reported profits. Why? Because profits are an accounting story. Cash flow is control. Here's the trick Musk uses that almost no retail investor understands. Delay profits today to dominate pricing tomorrow. Tesla spent years reinvesting every dollar back into factories, R&D, charging infrastructure. On paper, Tesla looked weak. In reality, it was building a system competitors couldn't match. Musk understands something critical. If you control cash flow, you control survival. If you control survival long enough, you control the market. He prices aggressively, even at thin margins, to expand market share, pressure legacy competitors, force weaker players to burn cash faster. While competitors reported healthy profits, they were actually bleeding long-term relevance. This is how Musk wins without fighting. Another hidden move, vertical integration. Instead of relying on suppliers, Musk pulls everything in-house. Batteries, software, manufacturing. This reduces short-term profits, but massively improves future cash flow stability. Once scale kicks in, costs drop. When costs drop, pricing power increases. When pricing power increases, competitors disappear. This is why Tesla can start price wars and still survive. Most businesses can't. Because Musk isn't chasing quarterly applause. He's engineering inevitability. And here's the final insight of this part. Wall Street rewards profits. Markets reward endurance. Musk builds for markets. After everything, risk, patience, failure, cash flow, people still ask the wrong question. How can I invest like Elon Musk? The better question is, how can I think like Elon Musk? Because his biggest advantage was never money. It was frameworks. Let's break the real secret down into principles you can apply, without rockets or billions. 1. Think in ownership, not income. Musk didn't chase salaries. He chased equity. For you, this means building assets, not just earning paychecks. Focusing on skills, businesses, or investments that scale. Owning a piece of growth, not just trading time for money. Even small ownership beats high income in the long run. 2. Take asymmetric bets. Musk risks only where downside is survivable, upside is massive. You can do the same by investing in learning before lifestyle. Placing focused bets instead of spreading yourself thin. Avoiding quick wins with capped upside. Small losses are acceptable, limited upside is not. 3. Use time as your advantage. Most people want fast results. That's why they lose. Choose paths where patience removes competition. Long-term skills, compounding investments, content, products, or businesses that grow slowly but last. If you can wait, you already have an edge. 4. Turn pain into positioning. Early struggle isn't a sign you're wrong. Often, it's proof others won't last. Use hard phases to learn faster, build resilience, create barriers others won't cross. Survival itself becomes leverage. 5. Focus on cash flow discipline. Whether it's personal finance or business. Manage cash first. Reinvest before rewarding yourself. Stay alive long enough for momentum to work. Endurance beats brilliance. The truth no one likes. Elon Musk didn't win because he was lucky. He won because he delayed comfort. He accepted uncertainty. He played long games others couldn't tolerate. And that option is still available. Not overnight, not easily, but realistically.